Has cost of thousands this morning, as usual. So I and Richard will be running through the news of the week, and then Andrew's going to be talking about the major moves of the February. And then our guest this week is Thomas Moore of Aberdeen Standard Equity Income. So a lot to look forward to. So news-wise, I couldn't really ignore the whole situation in Russia. So we'll be talking about JPMorgan Russian. And then the new IPO of the week, Cordiant Global Agricultural Income. And then Rich is going to be looking at a bid in the property sector for McKay Securities. JPMorgan Russian then first. As we know, the price has just collapsed. And it seems to be trading actually at a pretty chunky premium. I don't know why Morningstar hasn't actually put that bit of the chart on there, but really, basically the NAV is a bit indeterminate. It's been going since '97, so this fund predates the whole BRICS kind of fever. And obviously, there have been times when it's performed quite well. It did get hit quite hard in the global financial crisis, so actually it really did plunge, but rallied afterwards. Sold off again around the time of the Crimean invasion and the sanctions that came out of that, but did then climb back up again to hit a new high at the end of October last year. And at that point, the assets were about £400 million. And as things stand today, the NAV is estimated about 35. So you can see what's happened there. And a big chunk of that is cash, as we'll see here. There's been a lot of changes to the board. The chairman, Jill Knott's going to retire at the AGM today, and that was long planned. But two of the directors have resigned in the last week or so, and there's now 3 directors going forward. So which is sort of gives you one indication of the state of things. This is where the portfolio is now. About half of it is locally listed things, and the Russians basically have suspended trading in the market anyway. But before they even did that, they said that foreigners couldn't trade, and there's no practical way of getting money out of Russia. So I think even if trading does restart, it's quite unlikely that foreigners can be able to sell stocks and bring that money back. The money that's invested in ADRs and GDRs, so that's things listed in the States and here in London that represent the shares in Russia. Trading's been halting in those too. London Stock Exchange lagged the New York one. We've been a bit behind in all of this sanctions business, which is quite disappointing, but there we go. But it has happened now, and now you can't trade in those either. But it did have about 10.5% in cash. Most of that was in US dollars, which is obviously helpful. JPMorgan has said it's not going to charge a management fee going forward, which makes complete sense because there's not a lot to manage. And it will pay its dividend, so that there's a dividend that's already gone ex that will be paid on the 11th of March, but obviously there won't be any more dividends after that. And the share buyback's been suspended. Despite all of this, the board is recommending that shareholders vote in favour of continuation of the fund, and I think that's nonsense, really. As we've seen here, asset managers are really coming out and saying this place is just completely uninvestable for the foreseeable future. So BlackRock actually agitated to get Russia kicked out of the benchmark indices, and that's happening. So next week, MSCI and FTSE Russell are going to pull Russia out of the emerging markets index and the global indices. It doesn't make a huge difference to the global index, but to emerging markets, it was about 3% at the end of January. So will now be 0. I can't imagine that reversing for quite a while yet. I think it wouldn't happen until well after normal trading resumes, if it ever does. So that means that Russia is no longer an emerging market, and therefore not, really not of much interest to most investors, even regardless of whether you think it's a good idea to be investing there at all. Anyway, Fidelity come out and say we're not just going to touch Russia or Belarus for that matter. And even the JPMorgan strategist said, yeah, these Russian assets might look cheap, but don't go chasing them. And I think that tells you all you need to know, really. There's the AGM for JPMorgan Russian is at 2:30 today. I'd like to see people vote against continuation, see the thing wound up, to be honest. But there are all sorts of ways that it might happen. I don't think people have got their act together to change their votes ahead of this, so I think it might not happen today, but we'll just have to wait and see. There is a presentation that the manager is supposed to be doing at the AGM. So whether they'll let you in or not, I don't know, but there's an online presentation that you can go and watch, which the details of which are on our events page. And if you don't even manage to get into that, then the recording is going to go up on the JPMorgan website, so you'll be able to see what they said there. So watch that space. The new IPO, quite brave in the current state of the market. Obviously, GCP pulled its planned launch of the co-living fund, and Waverton's pulled its kind of relaunch of life settlement assets into an endowment fund. So this is going against the herd, but actually it's really quite differentiated. It's a whole another sort of brand new asset class that we haven't seen before. It's not investing in farmland. It's making loans to farmers, really quite large farmers, and people with about sort of $50 million of revenue plus. The money is supposed to be used to fund infrastructure and technology and things to make farms more efficient and more sustainable. And actually, the farmers don't pay the loans back. The money's repaid by their customers, so people like supermarket groups. So that's all quite interesting structure, really. There's quite a lot of security, as you'd imagine, and that's over the land and the crops, as we'll explain in a minute. And the yields are actually quite attractive that they're targeting. So looking for 6.5% yield once it's fully invested, and 4 cents in the first year, so 4% yield in the first year, and 10% total returns. And as Cordiant did for its digital infrastructure fund, they're going to do subscription shares on a 1-for-5 basis for people who invest at the IPO. So in terms of the security, you've got the loans only going to cover between 5 and 30% of the total crop. So there's quite a lot. So even if there's a partial crop failure, you shouldn't see a problem in terms of getting the loan repaid. There's a charge over the farmland as well, which is quite chunky. So to more than 150% of the total value of the loan, plus covenants around the actual cost of servicing the loan annually over the crops. And all of that gives you quite a lot of comfort, I think, that these loans are going to be repaid. But the thing that keeps coming across the analogy in my mind is the biopharma one. So again, something completely different. Trying to finance a sector that the banks might be a bit uncomfortable with, and therefore you get much higher returns you would normally. And there is some experience that they have been doing this. So they've made 475 million of these sorts of loans already. They've got teams on the ground in Canada and Brazil, and they have 8 loans in a seed portfolio with 100 million ready to go at launch. And as it says, they're a pipeline worth about 800 million. So I think actually this might fly. I mean, I wouldn't see it going to an FD premium or anything, but it does seem to stack up. But it might be that people are just so nervous in the current market that it struggles. But we'll have to just wait and see. I would imagine if they've gone out and actually pressed the button on the intention to float, that they must be fairly comfortable that people have expressed interest already, and they've got some investors lined up. Now over to Richard.
Great, thanks, James. Yeah, just a small one from me. So this week it was announced that Workspace and McKay had agreed a deal that would see Workspace acquire McKay and its assets. Now McKay have been a potential takeover for me for a while, really. Been heavily trading on a heavy discount for quite a while. But Workspace was not where I thought it would go, to be honest. I was quite surprised when that news came out, and I'll touch on that a bit more later. But details of it: so 209p in cash, and then 0.115 in new Workspace shares, which at the time of the announcement valued McKay shares at 297, and the business in total 272 million. Which was a massive premium to their share price of about 33%, but still a 9% discount to their estimated NAV at the end of January, which shows how badly they've been affected and trading at a discount. And this is why I don't think the synergies. There are synergies, but at the same time, there aren't, if you know. So Workspace, they do flexible workspace offices in London. So got 59 sites across London, and McKay are more looking at regional. Well, I say regional, but all in the southeast, but offices in sort of small towns around the southeast, and then quite a large chunk in industrial as well, which Workspace have no sort of specialty in at all. The synergies come from so McKay have spent a lot of money in the last few years on their office portfolio in making it sort of flexible for occupiers and things like that. So there's the synergies there. But if you look at what the combined group will look like after the deal, there's 2.9 billion, 84% in London, and only 5% in the southeast offices. Now, I thought if we look on the next slide, the rationale was that they wanted to sort of. Oh, sorry. We'll talk about the impact this had. So McKay obviously share price, which is at the bottom, shot up after this, but you can see Workspace investors didn't really take to it very well. It's gone down to 10% since it was announced. And then the rationale that Workspace gave for this was to expand their reach into the southeast, but it's only going to be sort of 5% after this of the total company, which isn't great. And they're going to have a massive, or a much bigger industrial portfolio, which they have no expertise in really. Yeah, I'm a bit surprised at this one. It will obviously give Workspace new avenues into new regions, and take flexible workspace out of London, which new ways of working after the pandemic. Companies may not wanting to lease on long terms and want more flexible terms. So I can see it working. Definitely can see it working, but a bit surprised by the news, to be honest. But they've got 37% of McKay shareholders have indicated that they will approve it. So I'm sure it will get off the ground, and it'll be really interesting to see how it works going forward.
I suppose since it's on a discount, just bids on a discount to NAV, you might see a counter bidder coming over the hill, but we'll see. Yeah. Couple of questions popped up here. Were McKay moving to a kind of flexible office type model? Yeah. So like I said, they'd spent pretty big sums of money in turning their office portfolio into flexible. They've got their own sort of branding for that as well. So yeah, that they've definitely been focusing on that. So do you think Workspace might just sell off the industrial bit? Yeah, I can't see where it fits in with their portfolio and their sort of investment criteria, really, unless they keep on a team at McKay that the industrial team and sort of have that as a separate. But I would have thought they'd look to sell that off, and given that the industrial market and how hot that is right now, they'd probably take a hefty premium on that as well. Cool. Okay. Let's talk to Andrew. Okay.
That's great. Thank you. Thank you very much indeed. I'll just switch over to my my screen and talk about the movers for February. Quite often when I do this, it does require a little bit of digging and thought on my part to find a theme. But obviously this month the theme is extremely obvious. There's one major factor that is completely overshadowing everything else. And that informs exactly what has happened in the market over the last couple of weeks. So amongst the gainers, and there were actually some significant gains in the market, the themes are really very straightforward, which are commodities and renewable energy. And I'll come on to talk a bit more about those in a minute. But some quite reasonable gains there in double digits for some commodity trusts, particularly those a bit more focused on energy. And on the downside, again, no surprise here, that the trusts with exposure to Russia have obviously been hard hit, and James was obviously just talking about JPMorgan Russian, which is the worst of them. So just looking at that and talking a little bit more about those with the exposure to Russia, we've often talked about the difficulty of alternative asset trusts trying to provide up-to-date NAVs, which take into account the latest information. And now this is a great difficulty for these trusts with exposure to Russia as well. And, you know, I think JPMorgan Russian have been trying their best actually to provide information to investors, but it's clearly been incredibly difficult. And actually their NAV announcements this week have been quite wild in the volatility. You know, on Tuesday, they were still saying the NAV was just under 200 pence, down to 128 on Wednesday, and then last night they said 87. And I agree with you, James. It's quite strange that the shares are trading on a premium to that. I think they're trading at 108 at the moment. That's a little bit hard to understand. There's obviously some hope of residual value somewhere, which is a little bit difficult, I think, to comprehend at the moment. What's happened this week, I think, is that any trust with exposure to Russia has tried to give a fair value at first, and now they've all given up and written them down to zero, nearly across the board. That's what's happened with the other trust that had major exposure, which was the Barings Emerging EMEA Opportunities, which did change its investment remit last year to broaden away from Russia a bit, but still had 28% of assets there at the end of January. They've managed to sell a little bit of that, a couple of £1 million worth, but most of it's just been written down to zero now. And Fidelity Emerging have also now written their Russian assets down to zero. They had 16% in Russia at the end of January, so again, quite exposed. What was interesting there was that the managers in January, they did buy an index short, and it's not very clear at the moment quite what impact that has had and whether it's still, whether they're able to extract the value from that short. So I think there's a little bit of uncertainty there. The other thing I think which is notable is that there is some small exposure, you know, scattered around the sector. So quite naturally, some other emerging markets trusts had some exposure. Templeton Emerging Markets, for example, was 6%, which is now, again, marked down to 0.65% at the start of March, and I dare say that'll be marked down to zero. Interestingly, I think in January I was asked, you know, whether the Mobius Investment Trust had much overlap with Temet, and I said no. And actually, Mobius said it had no exposure to Russia at all. But there are some hidden bits that maybe we weren't thinking about. So, for example, Baker Steel Resources Trust, which you would think would be a beneficiary of the rising commodity prices, actually had about 10% exposure to Russia through a couple of royalties and loans. And it has written those down by half, which has taken 5% off the NAV. But I think there's a fair chance it might just reduce those to zero. So that's something to watch out for. It is on a big discount, so I think that's probably already taken into account in the market. BlackRock World Mining had 1% exposure at the end of January. Monk's Investment Trust had 0.6% at the time of its last interim, so that was back in October, so that might have changed. But there's probably going to be a few more small bits of exposure that come to light over time. In terms of the winners, well, commodities clearly, which I talked about last month, actually, that's clearly been the sector that has benefited from recent events, and in particular its energy prices for obvious reasons, with big interruptions to supply now. On the left, we have the oil price, that's WTI crude. Brent crude's done pretty much the same thing. This really is a very, very large leap in the value, and we can expect that to feed through to inflation in due course, which has further implications for the sector. On the right-hand side is natural gas, where the rise has not been so dramatic, but obviously going in the same direction. There's no doubting the big shift in commodity prices that has occurred. And it's not just energy, actually. Food prices, I think, are going to shoot up because Russia is a very big wheat producer, so we've seen very large rise in the wheat price, and we've seen big rises in metals and really all the way across the board. But I think because energy has really been where the focus is, that's had the biggest impact in the investment trust sector. So Geiger counter, which we've talked about a great deal actually as a riser over recent months, that's had another boost from this because, of course, it may mean there's a need to fill in the gap where fossil fuels are not being used so much. And so it gives nuclear energy a boost, and therefore the demand for uranium. So Geiger counter has gone up by 23% over the month. And I think markets are thinking not just about the pricing of power, but about the security of the supply as well. Obviously, if you're buying in power from any other nation, there's always a risk of interruption. And I think that meshes very well with an investment desire now to have defensive income in your portfolio at a time of volatility. And all of these factors combine, I think, to boost the renewable infrastructure sector. So if you're looking for defensive income from domestically generated power and sector that can benefit from those higher power prices, this ticks all of your boxes. And so we're seeing quite big rises in some of these shares like Greencoat UK Wind, which I think is widely acknowledged to have the most exposure to short-term power prices. So that should be a significant beneficiary. And I think somewhat at the other end of the spectrum there, Bluefield's Solar Income Fund, which I think is much more conservatively managed, that has very good inflation protection because it has very large exposure to subsidies, which naturally rise. They have inbuilt inflation protection. So I can see the reason for those rises, and I suspect we might see some continuing demand there, because inflation, I think, is already very much at the forefront of investor thoughts and is likely to be the first question now that anybody is asking about when they're talking to fund managers. We'll see if that's true in a minute, James. But there are quite a lot of hedges available in the investment trust sector. And so there's plenty of opportunities, I think, for investors to build in some protection into portfolios. So apart from the environmental infrastructure, where quite often I think a 10% move in power prices is going to mean something like a 6 or 7% in NAVs for quite a number of those trusts. There are plenty of other sectors with inflation protections. Real estate is a big one because naturally a lot of the rental agreements, the lease agreements, have inflation escalators built in. So Urban Logistics REIT, for example, says that's true of a quarter of its leases. And one interesting one is the PRS REIT. which I've always shied away from for private investors, because anybody who's a house owner is probably accidentally overweight UK residential property anyway. But what is interesting about that one is that all of its houses are let on 12-month leases, which means it can renegotiate the rent every year. And that puts it in a very strong position to make sure it's moving with inflation. Financials are obviously an obvious beneficiary of higher interest rates. It helps the margins for banks. And one trust to look at there is Polar Capital Global Financials. I've been meeting the manager of that one, Nick Bryn, for quite a few years. And I think sometimes when I met Nick, he had a slightly hangdog expression, because nobody was interested in investing in banks at the time. And now, of course, his time has come, and the trust is suddenly on a premium rating, raising new capital, and everybody's interested. And there's a good reason for that. And the final category here is the old economy, really, which I think there was already a substantial shift occurring away from growth towards that more value style investing because of the duration argument of high interest rates. And now I think if you're looking for inflation protection, holding oils where you've got the power price increase, mining where you've got the commodity price increase, and banks where you can benefit from high interest rates, that suddenly looks like, a good portfolio choice. And there are plenty of trusts, actually very well established investment trusts, that have a focus on these areas. One I've highlighted is Law Debenture, which is the top performing UK equity and income trust over the last 5 years. So at the turn of the year, it had 10% in energy, 10% in commodities, and it also had Barclays and HSBC in its top 5 holdings. So it was very well represented in these areas. And also, as we'll find out in a minute, Aberdeen Standard Equity Income, in its last fact sheet, the top 3 sector exposures were these 3: financials, basic materials, and oil and gas. So I think it'll be interesting to hear what Thomas has to say about the inflation protection. But that's something I think which is going to be at the forefront of our minds probably for some months to come. Okay, that's it from me. I think that was fairly straightforward this month. Thank you.
Thank you, Andrew. Yeah, very good. Yeah, interesting, I think, what's going on with a lot of these things. Right, now then, let's